Good afternoon, guys. It's Saturday, July 22nd. My name is Dave Coker, and this is Talking About Finance. And oh boy, here we go. You know, I should have to pay to do this. It's just how much I enjoy helping people understand how to build wealth in a safe and low-risk way. Some call it old-fashioned, but I don't give a toss. If you only purchase assets that pay you to own them, then logically you will build wealth. It's that simple. It only makes sense. And in fact, it makes far, far, far more sense than trying to buy low and sell high, trying to time the market. And it doesn't matter what system you're using to generate trading signals. I've seen it all. Day trading, swing trading, momentum trading, the list is endless. You know, back on the farm, we had an expression, every dog has its day. And sure, all these systems may work sometimes, but what about the long term? By that I mean day in, day out, week by week, month by month. Do they work? No. The simple answer is they don't work. We know they don't work. Nobody on Wall Street makes money as consistently as the idiots, and I'm using that term deliberately, the absolute idiots who claim to make money by trading. It's ridiculous. And all I ask is you vet who's making these claims. Look them up on LinkedIn. And of course, many of these clowns use pseudonyms. Here's just a few. Master Trader, Trading Superstar, or my favorite, a bunch of people got this, The Trader. Okay, sure. You got to broadcast it? That's great. Using pseudonyms. What on earth can this be but a scam? So my advice is this. Sit back, chill, collect dividends, get rich slowly. It's the only way to be sure. But I'm sort of tired of this topic for this evening, so let's again talk about finance. You know, I eat, sleep, live, and breathe finance. I am the master of arcane market knowledge. So let's talk about finance. The S&P 500 closed the week up about 2.42%. Three sectors outperformed the S&P 500, specifically energy, healthcare, and financials. And you know how to read this chart by now. Red means it underperformed the S&P 500. May or may not lost money, but we know further that 8 sectors underperformed the S&P 500. Specifically, utilities, consumer staples, industrials, and materials all made some money, but they underperformed the S&P 500. And then 4 sectors printed a loss. Information technology, real estate, consumer discretionary, and communication services. I don't know, guys. It seems to me some steam's coming out of the market. Let's see how this plays out. The VIX traded up to 13.6. It opened the week at 13.34. Didn't really move at all. And I've got the data. I'm about ready to prepare a paper for my banking clients about the seasonality of the VIX. And yes, we're moving into a period where we tend to see second half of the year, markets are more volatile. By quarter, I'll break it down in the paper and I'll push some of it through Medium. You'll see it on Google News. But by quarter, it's a little bit different. But still, we're moving into a period of higher volatility. I have the data to prove that. The 10-year note closed the week at 384, flat on the week, and flat year to date. Oil closed the week at 76.91. It's up about 2% on the week, down about 4.2% year to date. You know, oil's going to be interesting to watch over the next few weeks. We're entering America's peak driving time. Everyone's on the road doing holidays. So you'd think it would go up. It'll be very fascinating to watch this and see how it plays out, because the other side that we can't see directly is demand. We can see the price of oil, but we can't see the demand unless we look at gasoline and stuff like that, which I'm not really given to do. And you know, I'm so damn boring, and I admit it, guys. Yesterday was Friday, so guess what I did? Yes. I bought Bitcoin, and yes, I bought Ripple. What else are we going to do with our risk capital? You can't keep it in the bank. And you do need to diversify. You can't go all in stocks, bonds, or property. You got to buy a bit of everything. That's what I do. But now let's find out what me and my buddies, some 50 or so finance professionals from all around the planet, talked about last week on a private Telegram channel. And once again, I was raised properly. I'm an American country boy. So let me introduce us We are global Wall Street. And between Telegram and our personal networks on LinkedIn and WhatsApp, we know everyone. We know people at many different financial institutions. So almost anyone in finance is just a connection or two away. And this week, of course, we're in the city of London. And yes, we're on Wall Street. We're in San Francisco, we're in Toronto, and we're in Shanghai. Somebody PM'd me, wanted to know what that meant. That means the memes that are being that we talked about were contributed by people in the city of London, Wall Street, San Francisco, Toronto, and Shanghai. We are global. We have people everywhere. Absolutely everywhere that matters. And a bunch of places that doesn't matter. It's okay, right? So let's go. 7 slides for 7 days. And I just got to tell you this, guys. I'm having the absolute time of my life. And this was an interesting one. Can't recall who put it up, but you know, if you got to ask this question, no. You don't want to be in on this, really. Just sit it out. You don't want to be buying those meme stocks. I wrote a paper for my institutional clients, excerpts syndicated through Google News. You can see it on Medium. Go to Google News, type Dave Coker in. You can pick it up, or go to Medium and look me up, connect with me. And no, these meme stocks, they're resurgent. No, you don't want to be getting into those things, guys. It's not really a way to build wealth. It's just gambling. And to be honest with you, there's other things that are just as risky that I'd rather gamble on. I never use the word investment to describe Bitcoin or Ripple. I don't regard them as investments. Bitcoin's very close to becoming an investment. Ripple, not really. It's still very, very risky. And Bitcoin, when I first started buying back in 2014, very risky. It's sort of calming down now, but getting back to these meme stocks, no, you really don't want them. And I'm getting this shirt for my wife because I do feel a little guilty. I'm talking to her about finance 24/7, or as long as she falls asleep most of the time. Yeah, that's what happens. But still, I'm thinking about getting this shirt. It's a wonderful shirt. And yeah, she'd look hot in it, hotter than she does now. But in any case, here's something you want to think about. And this is something I've mentioned many, many times, guys. You can invest in stocks, but you shouldn't. Like the gentleman at the top is repelled by the idea of buying stocks, but he likes the idea of buying stocks that pay dividends. And that gives you a great deal of protection, guys. I've read Galbraith's The Great Crash of 29 more times than I can count. Get a copy of it, read it. This is the original headline from back in 1929 when the market crashed. Now, yeah, I'm a little dubious about the market, what we're seeing now. And by dubious, I mean it wouldn't surprise me to see a sharp correction or an outright crash. And, we've got so many exogenous factors. And I keep pointing to that war, that land war in Europe, that potentially could go nuclear at any time. And you are really naive, guys, if you think if something that gets a sharp escalation, even something just short of nuclear, you're naive to think that these markets are just going to ride it out. They're not. Absolutely not. And I really don't care what the Fed's plunge protection team, we'll talk about that another week, but there is a group of the Fed that intervenes in market corrections, and I don't care what they're doing. They can't intervene. So try to not really get too crazy with your investments and buy yourself some dividend-paying stocks, and you'll thank me in 30 years. You can buy me a beer, okay? Yeah, and this is a good one because we're in an era now called Barb. Before, we were in an era called Tina. Tina meaning there is no alternative. Now we're in an era called Barb. Bonds are back. And yeah, you do need to have exposure to fixed income. You can get it a couple different ways. I like to get it primarily by purchasing ETFs in high yield dividend funds or high yield bond funds, and they pay really, really high dividends. And that's part of the reason why my portfolio is yielding current yields about 14%. It's been as high as 21% or even 18% going back before pandemic. So yeah, guys, you really want to own some of this asset class. Again, it's something that you're going to thank me for later on. They might be boring, but my God, you're going to really enjoy the cash flow. It's reliable, it's consistent, it's low risk, it's low excitement. Yeah, you want some bonds. And talking about Bitcoin, I'm so annoyed sometimes because I've been proselytizing in Bitcoin since I started buying it in 2014 every Friday. And I've been telling people to buy it, and they don't want it at 4,000. They don't want it at 9,000. They don't want it at 16,000. For some reason, they got some stupid attitude. I'm going to wait till it goes down. And then it pumps up to 30,000, and the media starts blabbing about it. And all of a sudden, they want the Bitcoin. Well, that's not the time to buy Bitcoin, guys. Really, what you want to do is you want to buy a little bit regularly, as I've advocated many, many times. And I've suggested, guys, that you take a look at Bitcoin and you buy it regularly. Could be weekly, like I do. Could be twice a month. Could be once a month. Could be quarterly. Could be annually. It doesn't matter. Although maybe you want to amp up the frequency from once a year. But still, when you do that, you employ something called dollar cost averaging. And you just buy. And that's all I do. I don't even look at the price. I don't care. All I want is the Bitcoin. All I want is to do the deal, do the transaction. Well, actually, a little bit more goes on. I want to push the money over to my brokerage. I want to buy the Bitcoin. I want to push the coins over to my hardware wallet because I ain't keeping no coins on no exchange, never. And then once they're in my hardware wallet, then that worked. And we can relax for another week. And that's really what I think you might want to try doing at some point, guys. And here's something else from the wonderful Plan B. Guys, look him up on Twitter. Fantastic gentleman with the research he puts out there. He gets a lot of abuse. And if you look at who's doing the abusing, it's idiots that buy and expect the stuff to go straight up from there. Yeah, they're absolute idiots. And, it's a family channel, so I can't use the word I really want to. It begins with A, ends in E, or S rather, and has SHOLE in the middle, but I can't say it, right? But they're complete jerks. Well, in any case, he's taken a look at this, or he's come up with this model, stock to flow. And it does work for other commodities, so we've got a good feeling that it works for Bitcoin. Like any model, there's forecast error. And the guy's so straight up. Look, he's done this table. I didn't do it. Nobody else did it. He did it. He's got the date, the era, if you want to call it that. He's got the stock to flow model prediction price. He's got the actual Bitcoin price. And then the last column is where he he looks at the error. Now, some people, they talk and they don't really understand econometrics. They honestly don't understand what the hell they're talking about. Yeah, there's forecast error. Get real, people. Every model has forecast error. But the thing is, and he's been getting some static for it. His stock to flow model is predicting for the era 1 year out, predicting a high price of 456,000 and change. Now, yeah, I look at that and I say, wouldn't it be sweet? It would be real sweet, believe me. But I don't care. What I did was this. I took a look at the forecast error and I averaged it like any good quant would, right? And when you average the forecast error, it's really fascinating when you tend to look at what it could be. Now, it turns out that the forecast error is roughly, taking a look at this forecast error, we can back into an adjustment overall for what it might be. Now, if I take a look at the forecast error, average it out, add it to the theoretical price of Bitcoin, it looks like we're in the range 411,000 up to about 501,000. Again, just a back of the envelope, back of the calculator type calculation. I certainly didn't ask him about it. It's just mine, and it's no big deal. I'll take it, run with it. I'll put your name on it. I don't care. But the point is, we do know that the Bitcoin price is going to go up. Look at the third column where he tracks the price. 28 cents, $7.10, $358, $5,816, $30,882. The price of Bitcoin is going up. It's exhibited in the chart below. The stock to flow model's got a target range and it's got an error. Deal with it. I would recommend you just buy some Bitcoin, but that's what I do every week. I'm boring. What can I tell you? All right, guys, that's it for this week. It's been a real pleasure speaking with you. And I really hope you have an excellent week going forward. I really, really hope everything works out for you. It's going to. The markets are crazy, but you can still pick up some value in the markets. Don't worry about it, guys. Just put your capital in, rock and roll. That's all we ask that you do. Thanks for your time, guys. Wife and I are going to the pub. What else are we going to do? It's grim and gray out there. And I need this weather because it suits my grim mood. So I'm going to the pub to get happy. Now I'm happy 24/7. Take care, guys.